Welcome to Insights for Outcomes. I'm Julia Newbold, Managing Editor at Connexus Financial, owner of Investment Magazine.
I'm joined today by Noah Weisberger, who is Managing Director in the Institutional Advisory and Solutions Group at PGIM, the global investment management business of Prudential Financial. Noah has been at the IAS Group since January 2020. He began his career as a staff economist at the Council of Economic Advisors and had 17 years on the sell side of the industry, including at Sanford Bernstein and Goldman Sachs Global Investment Research. At PGIM IAS, he applies his macroeconomic and policy expertise to the group's research and client advisory work that focuses on asset allocation and portfolio construction. The IAS team conducts bespoke quantitative client research that focuses on strategic asset allocation and portfolio and asset class analysis across both public and private markets. Welcome to you, Noah. How are things for you?
Thanks so much for having me. All is good here in the New York area hot summer.
So it's an interesting time, Noah, to be doing research on global economic conditions and the drivers of markets. And so I'm really interested in our discussion today, where we're going to focus on stock-bond correlations and the implications of your research for CIOs' asset allocation decisions. You've done research looking at the drivers of stock-bond correlations across global markets, but you began by looking at the US back in 2021. So let's start there. We see that for the last 20 years or so, the correlation between stock and bond returns has been negative. So CIOs could increase equities allocations with bonds acting as a hedge. Can you talk us through the findings of this initial research on the US market with regards to the history of that stock-bond correlation, why the correlation exists and what might be next?
Yeah, absolutely. And as you rightly point out, 20 years is a long time in the career of most CIOs, most investors, and market participants. You know, all we've known collectively is negative correlation, where stocks and bonds, as you say, hedge each other. But rolling the timeline back, earlier in the post-war period, we had about 30 years from the mid-'60s through 2000 of positive stock-bond correlation, and then coming out of World War II, a period of, once again, negative correlation. So what's really interesting about this phenomena, this market phenomena, is that, I think we're conditioned a little bit to think of things in a business cycle frequency, perhaps, or maybe even at higher frequencies. But this phenomena seems to last really, really long time. So 30 years of positive stock-bond correlation from the mid-'60s to 2000, and then 20 years of negative correlation. So whatever explanations you want to come up with, they can't really be simple and unified. They're really going to have to operate on a number of different frequencies and levers. And if you just think about that long period of positive stock-bond correlation, I think the subcontext here is that we've been through 20 years of negative stock-bond correlation. What could be next? Well, I think what we're trying to tell people is what could be next is a period of positive stock-bond correlation for some of the reasons I'll discuss in a moment. But if you think about the previous long mid-'60s to 2000 period of positive stock-bond correlation, there is no simple, that was 30 years of X, Y, and Z. It was an oil price shock. It was Volcker raising rates and then rising inflation and then falling rates and falling inflation. It was Clinton surpluses towards the end of that period and a tech bubble towards the very end of that period. So not very easy to classify that long period. And so what we've done is we've tried to link this long, slow-moving stock-bond correlation to macroeconomic factors, and in particular macroeconomic factors that then themselves relate back to kind of big policy elements of the policy environment. And so we think of the drivers of stock-bond correlation from like the long-term thematic as a function of fiscal sustainability issues, the degree of monetary independence, the degree to which supply or demand is driving the economic cycle, and then a little bit about investor sentiment. And what's interesting about these kind of policy and environment type framework is that it connects very naturally to what we think of as kind of the building blocks, the kind of statistical building blocks of stock-bond correlation. So we like to start with stock prices and bond prices as being discounted sums of future cash flows. It's a very basic definition. And if you write that process out, what you quickly come to as an expression for stock-bond correlation is that stock-bond correlation is a function of the volatility of policy rates, the correlation of economic growth and policy rates, and the correlation of equity and bond risk premia. And those naturally connect back to the degree of fiscal sustainability, the degree of monetary policy independence, supply versus demand. We think those all have natural expressions in these more quantitative macroeconomic factors. And so if I were to think about what could come next, as we live through this negative period of negative stock bond correlation, I would say positive stock bond correlation is associated with worries about the sustainability of fiscal policy, less rules-based and less independent monetary policy, or at least concerns thereof, supply-side economic drivers, and the tandem repricing of stock and bond risk, sort of a risk tandem move in investor sentiment towards those two asset classes. And that would find expression as greater policy rate uncertainty, greater volatility of interest rates, the negative co-movement between economic growth and policy rates, and the positive co-movement of stock and bond risk prices. So those are the things that we think have in the past driven stock bond correlation, at least in the US, and prospectively going forward is what could push us into a positive regime from the negative one that we've become accustomed to.
So more recently, you took that research and applied it to global markets. Did you find the same sort of factors applied in terms of the drivers of the correlation in global markets?
Yeah, so it's really interesting to me when we start to look at the global question. So we looked at the U.S. in conjunction with a handful of developed market economies. And so much like in the U.S., we take U.S. stocks and U.S. bonds and look at that correlation over time. For any given, the UK, you could take UK bonds and UK stocks in pound sterling and look at that correlation over time. Japan, Germany, and so on. And what really struck me and kind of was counter to my own expectations was the degree to which DM stock bond correlations all move together. And more importantly, for asset allocators and CIOs, developed market stock bond correlation regimes. Is stock bond correlation positive or is it negative? It seems really synchronized across the developed markets. And there doesn't seem to be any evidence that we can find that one country leads or lags systematically other countries. So there seems to be this simultaneous and joint determination of developed market stock bond correlation. Obviously, they don't move in lockstep, and there are periods of time where they differentiate themselves one from another. But to a first approximation, it really, very, very, very easy to see in the data that there seems to be a lot of coherence and synchronicity across developed market stock bond correlations. And so, in some ways, that kind of makes sense, right? It makes sense because if you look at stock returns in isolation, there's a very large global factor that drives stock returns across developed markets. And equivalently, if you just look at sovereign bond returns in isolation, there's a very large global factor that drives bond returns. And so if stock returns are kind of global and bond returns are kind of global, it's natural to think that stock bond correlation is therefore global. But where the tension exists, I think, is that at least in my own kind of prior thinking about the global story was that the U.S. story in our initial work seemed to be very much predicated on policy conditions in the local economy. And yet we have this really, really strong global force that seems to be driving, as I said before, kind of a simultaneous and synchronized movement in stock bond correlations across the developed market. So it was a little bit of an eye-opener to me relative to my own expectations, what we found initially in a very first look at the data. There's a lot more global coherence than I was anticipating, especially given my own priors that stock bond correlation was determined by fiscal policy sustainability, monetary policy independence, things that are very kind of local to the local economy.
It's nice to be challenged in your own research about your own predispositions. So that's a good outcome, Noah. So these two tensions that you've outlined, the global factors, the monetary and fiscal policy, things like that, and the local factors like the investors' behaviour and investor sentiment are driving the correlation. Can you unpack a little bit for us the extent to how much each of these two factors are driving the correlations? Is it an equal kind of driver, or what does that look like?
Yep, absolutely. So the way the data kind of break in the statistical analysis, we try to kind of measure carefully global economic factors and economic policy variables. And to be very candid with you, we use the U.S. as our measure of global. So when I say global, I really kind of do mean U.S. In our analysis. And then we try to extract the U.S.'s influence on local economic variables and just use that purely local leftover bit. So we looked at the impact of U.S. policy rate volatility, the correlation of U.S. economic growth and rates, and the co-movement of U.S. risk premia alongside purely local versions of those three variables. And it sounds like a complicated process, but we came out with a very kind of neat and clean answer, which is it seems to be that about 2/3 of a developed market stock bond correlation movement is due to U.S. factors, and about 1/3 of the movement in an individual DM's developed markets stock bond correlation is due to purely local economic drivers. And so, like most things in life, the answer is never clean cut and easy. It's not like CIOs ought to pay attention just to the U.S., and it's not like CIOs ought to pay attention just to what's going on in their local economy. They really need to be paying attention to both local and global developments. That said, this is I think that's a very clear result. Is 2/3 global, 1/3 local. But in terms of the actual individual drivers, it's not quite black and white. It's a little bit more gray. But it seems like the U.S. economic factors that relate a little bit more to policy. So the volatility of interest rates, which probably has a lot to do with how predictable and rules-based monetary policy is and how sustainable fiscal policy is, and the co-movement of economic growth, U.S. economic growth and U.S. rates, which probably has to do with supply versus demand drivers and probably has to do with the degree of rules that the monetary authority is following. Those two variables, the U.S. version seems to matter more. And the risk sentiment measure, that co-movement between equity and bond risk premia, the local version seems to matter a little bit more. So if I had to kind of dig in, peel apart the onion like one layer deeper, 2/3 global determinants of local stock bond correlation, mostly focused on U.S. policy risks. 1/3 local determination of local stock bond correlation, a little bit more about sentiment in the local sentiment rather than U.S. sentiment.
So if we kind of summarize then the most important factors in determining the stock bond correlations, it's volatility of policy rates in US and local markets, but more on the US side, correlation between economic growth and interest rates, and the co-movement between equity risk premia and bond risk premia. Can you give us a little bit more meat on the bone on each of those and expand on that for us?
Yeah, absolutely. And I'll go a little bit out of order. To me, the co-movement between economic growth and interest rates is like just an amazingly fascinating summary statistic, if you will, for a lot of deep economic intuition. And I think to me it captures what's driving the economy. If you think back to an intermediate or introductory economics class, is it a shift in the supply curve or a shift in the demand curve? Is the monetary authority trying to surprise the economy with the degree to which they're being overly easy or overly tight? Or is the monetary authority responding to the strength or the weakness of the overall economic environment? And so none of this, just as an aside, none of this is about the level of interest rates or the level of inflation. In our framework, it's all about the drivers of and the co-movements of. And I think that's a very, very important distinction. And so in a world where demand is driving the economy, and so greater demand pushes up prices, pushes up inflation, pushes up interest rates. In a world in which growth starts to accelerate, so the Fed needs to raise rates in response, that's a world where you have positive correlation between economic growth and interest rates, and a world where you have negative stock bond correlation. And that's, as I said, a function a little bit about the predictability of monetary policy. So think of the Fed, if they're following a Taylor rule, let's say, where they're concerned about unemployment and inflation, if they are independent of fiscal policy considerations, that's probably what you get. Secondarily, I would put the volatility of interest rates as pretty intuitive. And there, to the extent that we're concerned about the forward outlook in terms of fiscal sustainability and the ability to maintain debt to GDP or even pay down debt to GDP, and to the extent that we know what policy is going to look like in the future because the monetary policy authority is predictable and acting in a rules-based way, that leads to muted policy rate volatility and probably to negative stock bond correlation. Conversely, if we're worried about the sustainability of fiscal policy, if we're worried about the independence of monetary policy, and if supply shocks or a Fed that's behind the curve and trying to catch up those would all kind of push you in the positive stock-bond correlation direction. And in terms of risk sentiment, I think the intuition is pretty clear, which is if we're repricing risks wholesale in an economy, that would tend to move risk prices together. For instance, in the current environment, there's a little bit of a reverse causality story there too, perhaps, which is if we realize that the policy factors are leaning towards a positive stock-bond correlation, well, then both bonds and stocks look a lot riskier than they have in the past. And so maybe we need to lower the price of those assets, increase the risk premium, and then the forward return will compensate you for that incremental risk. So when we're re-rating risks, that tends to induce positive correlation in risk premium and positive correlation in reinforced positive correlation in stock and bond returns themselves. But if we're talking about risk on, risk off, like I'm selling my stocks, I'm buying my bonds because I'm worried about something, or whipsaw, all of a sudden I get a lot more comfortable with the outlook and I sell my bonds and buy stocks, that's a negative stock-bond correlation world. And we think that sentiment variable is a little bit more locally driven than it is globally or U.S. driven.
So we've talked a lot about the drivers of the correlation, and you touched on it, just a little bit there. I'm interested now in shifting the conversation to what it would take to actually see a shift in the stock-bond correlation. So can you give us a little bit more about that? I know you just mentioned it a little bit.
Yeah, absolutely. So one thing to say as a caveat, in our formal research, what we look at is a long-dated correlation measure. So it's 5 years. It's centered, so it's somewhat backward-looking, and so you won't know for a while if that is going to permanently. Is going to shift from negative to positive. But on a higher frequency basis, it does seem as if we're starting to get some evidence that stocks and bonds have been moving in tandem for about the last 6-9 months, maybe a little bit longer than that. And I don't think it's I think you can connect that back to some of the debates that are swirling currently. Right, we have a lot of fiscal spending in the U.S. that's sort of heightened concerns about fiscal sustainability. A lot of the conversation a year ago or 18 months ago was about the balance between growth and interest rates, and if that leads to a sustainable path or an unsustainable one, and then we spend more, and maybe those risks become, the balance of risk shifts there. There's certainly a lot of debate whether or not we're experiencing demand-driven inflation, or if there's a supply-side component to that. And if supply side is driving things, it also looks a little bit different. And so those are some of the things that I think are square on the radar screen. We're not making forecasts here, but we are trying to put on people's dashboards, if you will, the sorts of issues that they should be paying attention to evaluate stock-bond correlation.
So I know you don't want to make predictions, but is it fair to say then that we, given these findings, are facing or about to face a different world in terms of the stock-bond correlations?
I think there's an argument to be made that the balance of risks has shifted. And I think the other message that we want to leave investors with is, as I said before, what would be the risk indicators or the policy indicators that would make you start to think about this world? And the second really important part of that conversation is what does that world look like, right? So how different is a positive stock-bond correlation from an asset allocator, positive stock-bond correlation world for an asset allocator relative to a negative stock-bond correlation world? So I think those are the two important components here. One, what should be on the radar screen for evaluating the balance of risks? And two, what would that new world look like should we find ourselves in a positive stock-bond correlation world?
So we'll get to that in a minute in terms of what that would look like. But sort of before we get to that, how do you think CIOs should be approaching this? So, assuming that we are about to face or facing a different world in terms of the correlations, how costly is it when we shift into that different correlation environment, and how should CIOs be behaving given that they don't know the future?
Right. Well, I think one thing is important to bear in mind, which is that this ends up being, from the perspective of a balanced portfolio, a much more volatile world. And that means that off-path outcomes, sort of tail outcomes and extreme events are larger, are more damaging. And some of the risk metrics that used to be achievable, a certain level of portfolio volatility or a certain target Sharpe ratio, they just may not be achievable when you don't have that extra buffer coming from negative correlation reducing volatility of the portfolio. You just don't have that anymore. And so we think that's a really important message. As for, what actions can you take? The risk is that you don't want to get over your skis in one direction or another. And so one of the things that we've been looking at is, can you, without being able to forecast correlation, should you assume it's always negative? Should you assume it's always positive? Or should you take a more agnostic approach? And what would the damage be from each one of those approaches relative to the other ones?
And so if we do move into that positive correlation world, you've mentioned that investors should be aware that there's certain Sharpe ratios or volatility levels that aren't achievable. In practical terms, does that mean, re-looking at their return targets? Does it mean looking at different defensive assets? What does it actually mean in terms of the allocations?
Yep. So let me pick up on the second thing you said first, then back to the first one, which is the inclusion of other assets in the portfolio. So we've looked at this a little bit. A couple of things. We're talking sort of the quest we're on when you frame the question that way is, in a world where bonds are no longer a natural hedge to stocks, is there another asset out there that we think could be added to the portfolio, replacing or filling out the portfolio to replace that hedging job that bonds used to do? And there we've been, the answer kind of is, unfortunately, we don't really think that there's an asset that jumps out at us that really has the right characteristics. And I'll kind of go through a couple candidates. The first is, if from the perspective of a U.S. investor, if U.S. bonds don't hedge U.S. equities, would U.S. dollar developed market bonds be a hedge for U.S. stocks? In other words, if U.S. bonds don't do it, is there another developed market bond that you can put in the portfolio? And the answer, intuitively, I think from the way we've been talking about things today, no. Developed market bonds look too similar for one to be a hedge when U.S. bonds are not. EM bonds also don't offer those hedging properties the way a U.S. bond would. And then, of course, there's the commodity complex. A lot of people look at the commodity complex as an inflation hedge, but when you kind of condition on when bonds are not a hedge to U.S. stocks, are commodities a reliable hedge for U.S. stocks? The answer is kind of middling. On the one hand, yes, commodities are mildly negatively correlated with U.S. stocks when U.S. bonds are not. So when you don't have a bond hedge, maybe you have a modest hedge from commodities. That said, commodities are at a much higher volatility than bonds. So do you really want to replace like a 7 vol asset to hedge your equity risk with a 20 or 30 vol asset when the degree of hedging is kind of modest? So I don't know that there's an obvious asset to add to the portfolio to try to replace the bond hedge. That said, I think really the heart of the issue is kind of what you said at the outset of that question, which is, how should you think about return targets? How should you think about volatility targets? And here's the trade-off that investors are going to face. You can maintain your return target, but it's going to be achieved at a higher volatility. So if you have a risk manager and you have a firm ceiling, a firm volatility ceiling, you're going to be bumping into that ceiling a lot more often in a positive correlation world than you would otherwise. And that can, sort of a little bit about a risk management and the risk tolerance question. Alternatively, and you may need to do that. If you need to achieve a certain return, it may be worth increasing the risk budget to do that. Alternatively, if the risk budget is really fixed and firm, you may need to accept a lower return in order to maintain that level of risk in the portfolio. So it's like the canonical risk-reward trade-off. How you respond a little bit depends on your objectives and the purpose of those sorts of constraints on the investment process. But I think that's what we're trying to highlight to investors, that if we go into a positive stock-bond correlation world and do the planning now and do the thinking now, what's the set of reasonable outcomes to expect for this portfolio? What are the risk scenarios? Drawdowns will be deeper. Tail events will be more damaging. Those sorts of things are going to be true. And so how do you want to react in that kind of framework?
And, the evidence seems to suggest that, whatever environment it is, a positive or negative correlation persists for some time. Can we expect that if we do move into that positive correlation environment, that it will be, a decade or two rather than a short period of time?
Right. So I'm not sure how to answer that question with any degree of certainty. But look, we don't have no history. We have 50 plus years of U.S. history. And the kind of the deep irony of stock-bond correlation is that it doesn't change until it does, and then it persists. And so, driving in the rearview mirror, as they say, I think a shift in correlation to positive territory would likely be persistent. And why would that be? It would be because it's mostly about, kind of investor expectations about policymaking, and that's a really slow-moving object. And so I would say that if we start to get evidence of a positive stock-bond correlation, that's probably the world that we live in for some time. That said, I've heard people argue that, what seems to be persistent supply-driven inflation is really just transitory. The Fed will quickly get back to a point where they are no longer perceived as being behind the curve, but back to their rule-based mandate, if you will. And so maybe this is just a moment in time, but history suggests that these moments in time really do persist.
So, Noah, the reason you embarked on this research in the first place is to look at the assumptions that investors make and challenge those in terms of how they might change and whether those assumptions still hold true. What's next on the research agenda in terms of challenging investor assumptions and delving into that in some depth?
Yeah. So most immediately, it's to look at the optimal response to such a shift in correlation. Dig a little bit more deeper into other hedging options and think through as granularly as we can about what that would look like. What would an optimal portfolio look like for different classes of investors? And how right do you need to be about correlation to be comfortable to make that call, or maybe take an agnostic approach as the data reveal itself is not too costly. So we're trying to calibrate some of those immediate continuation on the same theme, some of those immediate questions that follow up naturally as you've been asking from this research. And then more broadly, I think the stock-bond correlation question kind of fits in nicely with the broader research we do in the IAS group, with a big focus, as you said, at the very, very top of our conversation, on portfolio construction questions with both liquid and illiquid assets. So how does the interaction between a shift in correlation in the public part of your market, a public market part of your portfolio, perhaps interact with the decisions you would then need to make on the private side, especially in the context of the allocations we've seen and the shift in allocations we've seen on the private side. And that would kind of dovetail nicely with other streams of research that are ongoing at IAS, as we already ongoing at IAS.
So I think it's really important research for investors and for CIOs as they're looking to their asset allocation. Thank you so much for sharing it with us. It's been a pleasure speaking with you, Noah. Thank you so much for your time.
It's been my pleasure, and thank you so much for your time as well.